Hello and welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us. Today is Tuesday, the 7th of September of 2021, and we're going to discuss what we're paying attention to on a go-forward basis, what we're thinking about at Blanke Schein Wealth Management for our clients, so you should be too. So thanks for watching. Before I begin our update today, I want to say a special thanks to all of our clients, friends, and family. You know, this year has been moving along very quickly, but our ability to communicate and stay connected via our video updates has been second to none. You know, this is our second year now that we've instituted this, and you know, by our data, we have empirical evidence internally that show, you know, not only do we have everyone here in the community at large, but all of our clients, most of our clients are, especially when it's 120 degrees outside like it is today in Palm Desert, California, you know, our clients are all over the United States, everywhere from Maine to Florida, Alaska, Hawaii, and everywhere in between. And we don't blame them because there's better weather than where we are, at least for the time being. And we're looking forward to fall where we are. But we're also, as far as Croatia, we've got clients that are traveling the world and clients that spend time away from us. In the summertime, they spend, you know, vacationing or in their second property, all as far away as other countries. And that being said, we're spending our time staying on top of markets, managing portfolios proactively, and being defensive when we need to be and offensive when it's opportunistic to be. And that being said, you know, let's go through some of our research that investment committee sort of sourced over the weekend and as real as this morning. So the headline right now that we're paying attention to is all eyes are Congress, right? Just after Labor Day weekend, vacation is over. And so the next few months are going to provide sort of what we believe some risks to pay attention to. Again, we'll take advantage of them for our clients. We've sort of raised some cash, and we have cash coming in from many of our clients from the banks, because again, banks aren't paying us anything in a rising inflationary environment that we're in. It's good to sort of have the ability to make some money on your money versus the banks making money on your money. So that's important to know. But the risks that we see perceived ahead, let's just get right into it right now. Congress is now going to be debating what the size of the next round of stimulus, i.e. infrastructure or even just assistance right there on a go-forward basis. Now, the number that we've heard, at least from the beginning of the year through the summer and now, is the 3.5 trillion spend over 10-year period of time. Again, there's some budget and some sort of horse trading that's going to go along, and some budget sort of analysis, whether they could afford it or not. The answer is we can't afford it. The answer is Congress is sort of controlled by the Democrats, so there's a good chance that it could be work its way through. But the Democrats are intent on a bipartisan approach to this. In fact, that's the best way to do things. It doesn't matter who's in charge, so that you can get sort of both camps in overwhelming support on a go-forward basis. Now, there's a lot of debate in our financial sort of press, if you will, recently, as to how quickly Congress could take a 3.5 trillion and make the Joe Manchins of the world from West Virginia, sort of fiscally conservative, moderate Democrat, to say, hey, listen, we're just going to cut it in half and have a headline number of 1.75 over 5-year spending. But look what they did. They just cut it in half. That doesn't mean that the 3.5 is literally reduced to 1.75. But at the same time, if we do this, then they're also going to bring the Bernie Sanders camp in and get sort of that support right there, because that means that all of his special projects, at least is what the financial journals are saying, everywhere from the Wall Street Journal, Barron's, and a few others, this is what's going to happen over the next few months over Congress. They can get Bernie Sanders even to sign on more of a supportive, even bipartisan support, get some Republicans in there too, on a go-forward basis. Whatever headline it is, whether it's net or gross, now they use offsets, right, in the budget process, whether they're bringing in, and we're going to be spending a lot more time on this. I'll even have an outlook next month for our clients of more of a detailed sort of approach as to what could be, but I don't want to spend too much time on what could be. We just know that whatever they bring in is going to be way of taxes, right? Because they have to offset some of the spending on a go-forward basis. Now, the risks in the meantime, while Congress is in session, now keep in mind, the market has been up, NASDAQ, S&P, Dow, over the last few weeks. And one of the big reasons, and sort of inside sort of the the thought process on Wall Street is when Congress is not in session, we are all safe, right? Or when there's gridlock, we're safe. And so markets go up as a result of that. We know that they can't tax or spend. And so now Congress is back in session and markets have sold off. Is that a coincidence? We don't know. But we will be cautiously optimistic as on a go-forward basis because there's risk to growth on a go-forward basis. The GDP and stagflation is now sort of in the headlines over the weekend if you watch any of the financial press. Now, if you follow along on a Friday Insights, August 10th of earlier this last month, on August 10th, I gave a Friday Insights describing what stagflation is. And quite frankly, it's basically the rise of inflationary with sort of wages and a few other things just staying the same. So you sort of have this feel the pain of everything around you that you spend money on is going up. But yet you just can't get out of sort of that growth environment that you need on a personal level. Now, there are some sort of counterbalances to this. We are seeing in Friday's data on the employment report that there is wage inflation, which is good. Obviously, it'll never be enough because everything that you and I spend money on, which is education or healthcare or whatever it is, that's a double-digit inflation rate. So there's always that arbitrage there. Let's be honest. But the GDP, there's also talk about that the GDP might be, it's being reduced down by Goldman Sachs and a few other financial institutions simply because they have the threat of stagflation. Now, what does that really entail? At this moment in time, we could see a reduction in production and a reduction in consumption for the third quarter. That's why estimates are coming down in Wall Street, not because the demand is not there. Okay, let me be clear on this. This is very different. The demand is there. We're seeing demand in housing, demand in autos, demand in just about everything on the supply chain. The supply chain is disrupted around the globe. A lot of sort of, there's the ports right now, if you read a report in Barron's, the ports in LA are overflow, and there's over 30 different shipment containers, big shipment container boats that are waiting to come back and deliver that. And I can see that the railroads are constantly working 24/7. It's now sort of supply chain disruption. So therefore, you're not going to get as much consumption to report to a larger GDP number. So you're going to see that shrink in the GDP for the third quarter. It's very possible. But keep in mind, it's not due to lack of consumption. The demand is there from the consumer. And that's very key to see if we're in a healthy economy. But that's a risk to growth right now. And so we have both the GDP number coming down. We have inflation as it relates to everything we're spending money on, but yet maybe wages can't keep up. So that's a very big risk right there that we're going to see. And that really then comes to the next step, which is policy, the Fed. Now, Jerome Powell, the Federal Reserve Chairman, is up over the next few a month or so in terms of a renewal. There's majority odds-on favorite in terms of he's going to get the sort of re-election for the Federal Reserve Chairman, but there's no bets. I mean, that could be a risk that could play a headline and some fear on the insecurity. But so what would keep Jerome Powell from there? Well, it would be the Bernie Sanders camp putting pressure on the Joe Biden White House to say, wait a minute, there's not as much of our agenda being or our representation in the Federal Reserve. So this could be very political. Again, that's another risk to our future policy because the Fed has said very clearly they're going to be accommodative and dovish. And essentially, when the Fed sees bad news, that's good news because interest rates will be lower for longer. So we saw a weak jobs report on Friday. That just means that the Federal Reserve will continue to be making its taper or purchases versus tapering, keeping interest rates low and accommodative for the policy. But that's in threat. That's a risk, depending upon if Jerome Powell gets re-elected or renominated and maintains the position of Federal Reserve Chairman. And then the legislative agenda, which is Congress right now. It's the horse trading that we could see continue to transpire as Congress constantly does it. So you're going to see bipartisan support, then not bipartisan support. We could even see sort of in the short term, does the debt ceiling get extended? And Republicans can use that as sort of a political tool in the negotiating process for the greater, bigger picture here. So that is a threat. Those are three threats, three risks or threats that we see on a go-forward basis. So watch financials and how they react. Watch the S&P 500 in terms of its short-term 50-day moving average support. As we are here, and we're going to pay attention to that on a short-term basis. But September and October always seem to be turbulent from time to time. Again, we're positioned. We welcome it. We know that we're going to have sort of earnings will continue and earnings drive markets. So we can see some certain companies that are well run, strong balance sheets, positioned right in their sort of in their lane, in their sector, if you will, still be able to execute and make more money with less people out there. And again, today is the day where 7 million people are off government sort of assistance. And so now they're going to be back in the marketplace looking for jobs once again. So that's all healthy. We all need that on a go-forward basis. And hopefully those that need assistance get the additional assistance that they need. But right now, I can't tell you a small business owner that we have as a client or I see here locally that is not looking for help wanted signs. So hopefully these people find a job pretty quickly. So thanks for watching, and we'll see you again next time or later this week.